name is Dawn, and in the last video, we have talked about how to analyze stocks, and this is part 2 where we'll be conducting the financial health check on the company to make sure that we're investing in a financially sound and profitable company. So without further ado, remember to go ahead and watch the last video on how exactly to do step 1, but we're going to jump right straight into step 2 over here, which is on the financials. And that's the second step of the business financial valuation and management, aka the 4-step model that I use to analyze and spot great stocks. So let's try to understand why exactly do we need to read and analyze the financial statements. And that's really because you want to be making sure that the company shows you the money. Alright, so this is a great meme that I really like. But what exactly is the financial statements comprising of? That generally can be divided into 4 types, where we'll look at the balance sheet, which captures the net worth of the company, and this is where you want to be paying attention to what the company's assets as well as liabilities are. Now, you always want to potentially discount their assets, because assets can actually, the value of the assets can go up and down, especially if they're in some asset classes. For example, property, when there's a recession, property prices go down, so then that assets would get revalued, right? But one thing that you can't run away from is often the liabilities, because no matter how much the economy shifts, no matter what changes, you still have to pay your rent, you still have to pay the debt that you owe your suppliers or your creditors. So I always focus a lot more on the liabilities, and I tend to discount the assets when I read the balance sheet. Now the next one is the income statement. So the income statement is where I go to look at whether or not the company is making money. I will zoom in into the revenue that the company is generating, as well as the cost of expenses, because if the revenue is increasing but the cost is actually increasing at a faster rate, then that shows that the company is growing but not managing the cost well. And then that could be a problem, because if the growth in the cost is actually going to outpace the growth in the revenue, then in long term that's going to be really, really bad news. So I would look into the revenue, I'll look at the cost, and I would also look at the net income or the gross profits. So those are really important line metrics that I'll look at when I zoom in on the income statement. Now the other portion I'll also flip through to find would be on the shareholders' equity. So this is something to take note of, because at the end of the day we're shareholders and I want to be understanding how much equity there is. And lastly, would be the cash flow statement. This basically is where it captures the cash flow of the company, and generally there are 3 ways where the cash flows is usually divided into. We usually look at the cash flows generated by the operating activities, the cash flows by the financing activities, as well as cash flow from investment activities. So without further ado, let's just go straight into application, because I don't believe in too much theory. We're going to look exactly how to do this, and I'll use and start with an example of Facebook. So this is actually taken from Facebook 2019 annual report, and you can see over here in the income statement, I zoom in straight into the revenue and cost. So you can actually see that's pretty healthy. In fact, Facebook has generated great revenue. Costs have definitely, obviously, have to increase in order to meet their growth, as well as to service more. You know, there's all the server costs and staff wages that they need to pay, so on and so forth. But it does look like Facebook is managing those costs well. And looking at the income from operation, that is also pretty healthy. So nothing that's really too much of a red flag for me. The only thing that I'm not the happiest about definitely is the drop in the net income between 2018 to 2019, because you can see while they were 15 billion in 2017, and then that went to 22 billion in 2018. However, that then later dropped to 18 billion. But we can't really blame Facebook, because there has been several stuff that has happened during these few years. And you know, as an investor, when you really go and read into the news, you follow the actions of the company, you'll be able to understand and appreciate these financial numbers better, and understand if this would be a one-off or actually more recurring or more long-term in nature. So that's really important to evaluate. The next portion, let's look at the cash flow statements of Facebook. So in Facebook cash flow statement, you can see I would usually zoom in straight into the net cash that is being generated from the operating activities, because that is the heart and blood of the company, right? Financing and investing usually is the second and the third priority for me. So over here, I can see that they're generating great net cash from their operations, and that's something that I'm really happy about as an investor. Now, then let's look at the balance sheet. So in the balance sheet, I would pay attention attention to the cash because real hard cash is the most important to me. As for other stuff like the marketers bowl securities or anything else, I tend to kind of like just take note but not super pay a lot of attention on. And then there's also the accounts receivable, because if a company has large account receivables outstanding and year on year I tend to see that they are having trouble clawing back this money from their customers, then this is usually a red flag. But right now the account receivables of Facebook looks decent. I don't see any major red flags yet, so I'll keep monitoring this and then we will have to analyze that as the time goes on. Now, you also want to look at the current liabilities. So over here, the current liabilities is 15 billion versus 7 billion last year. And you can see that the current assets, on the other hand, is 133 billion. So that's a really, really healthy, that's a total asset. The current asset is actually 66 billion, right? Compared to 15 billion the current liabilities. So if you take the current assets divided by the current liability, that will give you the current ratio. And Facebook's current ratio is really healthy. So I'm not too worried about that. In fact, it's a great sign. Let's move on now to Netflix. Now, on Netflix case, you can see their revenue growth is fantastic. It's such a great story. It's such great numbers. They've gone from 11 million in 2017 and they're now at, 11 billion, right? Not 11 million, 11 billion, right? Because these are in thousands. Okay, now, so you can see over here that their revenues have actually been growing at an exponential rate. They've gone from 11 to 15 to 20. So that's really, really good. It's like double in just 2 years. However, if you look at their net income, okay, the numbers also seem to reflect the same growth stage, and the EPS is also really, really healthy. This looks really good. Now, however, let's now go into the cash flow from investing, the operating activities, and you can see that the net cash used in operating activities is actually negative. So this is, I wish the numbers were something else over here, but it's not the case. But it's actually still okay, because now let's look at the cash equivalents at the end of the year, and what they have is actually still really healthy at 2 billion in 2 years ago, and now it's at 5 billion. So that's not something that troubles me too much. And finally, let's look at the balance sheet of Netflix. So you can see the cash and cash equivalents over here, which you have already studied. Now, the current assets though, and comparing that with the current liabilities, you will see that Netflix position is very, very much different from Facebook. So whereas Facebook has so much asset that they don't really have to worry about their immediate liabilities that are outstanding or due anytime soon, Netflix, on the other hand, is running on thin ice. I mean, it's still kind of still okay, because if you take 6.1 divided by 6.8, that's pretty close to a 1, which is decent. Okay, and given Netflix position, I wouldn't be too worried, because they should be able, I expect them to be able to raise enough funds if they needed to actually do so to pay off the current liabilities. But it's actually okay. But you can see over here, just by comparing these two stocks, how their current assets and liabilities differ by so much, and as a result, this is something that you want to be paying attention to. But of course, don't forget to look at the other line statements as well as on under the liabilities portion, because I'll also look in general to try and understand what is their long-term debt. And then at the end of the day, wrap that up, because that marks the end of our second portion on financials. Now, you can go in deeper into the analyze statements if you want, but if you only have a quick few minutes to analyze the annual reports of your stocks, then this would be a simple walkthrough to at least glean a financial health status, and then you can move on into the valuations and the management, because this is not the end of your analysis. You still have some room to go, but I just wanted to let you know it's not as difficult as you think it is. So don't be worried even if you're not really good at math, because I've shown you some of the key line items to really zoom in and focus on. And that's the end of this lesson. So don't forget to like and subscribe this video by clicking on the button below. And we'll be talking really soon on the next portion, which looks at the management quality as well as the valuation. And of course, in the meantime, if you wanted to learn more, you can always go over to my website. And over there, I have written lots of articles on investing and personal finance. So I really love enjoying sharing these nuggets of wisdom with you guys. I really love sharing my personal investing journey and the knowledge that I've gleaned on this way. And I hope that this will help you, especially if you don't have too much time or energy to read thousands and thousands of books in order to learn the same skill. So once again, my name is Dawn and I'm Ashley Babe. Thank you for tuning in. I hope you found this useful. We'll see you again in the next video. Thanks. Remember, like and subscribe, and I'll see you then. Goodbye.